Commercial real estate investing has long been considered a lucrative venture for those seeking to build wealth and generate passive income. In fact, over 90% of millionaires own real estate, making it the most popular alternative asset class. However, it's natural to wonder if the potential rewards outweigh the risks and if it's truly worth venturing into this market. Today, I'm going to share with you 3 reasons why I think commercial real estate investing is worth all of the effort and whether or not you should buy commercial properties in 2023. First, commercial real estate has the potential for higher returns compared to residential properties and other investment vehicles. Commercial properties such as office buildings, retail centers, and industrial warehouses typically generate higher rental incomes and offer greater opportunities for appreciation over time. Let's walk through an example of how that would actually look. Consider a scenario where you have $500,000 to invest. You have 2 options: investing in a residential property or a commercial property. Let's compare the potential returns from each investment over a 5-year period. First, the residential property. With $500,000, you decide to purchase a single-family residential home for $400,000. You rent it out and generate a monthly rental income of $2,500, resulting in an annual income of $30,000. Assuming an annual appreciation of about 3% per year, the property's value would increase by about $12,000 annually. Over 5 years, your total rental income would be about $150,000, and the property's value would increase by about $60,000. Now, for the commercial property. Let's say alternatively, you invest the $500,000 in a commercial property such as a small strip center for $500,000. You lease it out to multiple tenants and earn a monthly rental income of $4,000, resulting in an annual income of $48,000. Commercial properties often have longer lease terms, providing more stability and potential for increasing rental rates. So let's assume the property's value appreciates at a rate of 5% per year. Over 5 years, your total rental income would be $240,000 and the property's value would increase by $125,000. And that's without even diving into what the valuation would be based on a cap rate, which you can learn more about here since we won't be diving too much into that in this video today. Comparing the 2 scenarios, the commercial property not only generates a significantly higher gross annual income, but also experiences greater appreciation in value. The higher rental income and appreciation potential in commercial real estate can result from factors such as prime location, strong demand, lease escalations, and favorable market conditions. Sure, this example is in a bit of a box, but I've seen this play out in the real world time and time again. It's also important to note that this example is simplified in both scenarios and doesn't account for various factors such as operating expenses, vacancies, property management costs, and potential risks. Next, commercial real estate can offer diversification and investment stability. By including commercial properties in your investment mix, you can reduce the risk associated with having all of your assets tied to a single asset class or even a single tenant. Additionally, certain sectors of commercial real estate, such as medical facilities or storage units, have demonstrated incredibly strong resilience even during economic downturns, providing very sought-after stability to investors. Here are a few ways that commercial properties offer diversification and stability. You can buy a variety of different property types. Diversifying your investment portfolio with multiple commercial properties is a prudent strategy. And in my own experience, it's far easier to scale with multiple commercial properties than it is qualifying for residential investments. You can also enjoy longer lease terms. Commercial leases tend to have longer terms compared to residential properties, providing a stable and more predictable cash flow. These leases are often in the 5 to 10-year range, and you'll have a variety of tenants leasing your space. Tenant diversification is a great way commercial real estate offers stability, as having multiple tenants reduces the risk of vacancy. They'll typically be in different industries, so you'll never be too heavily exposed to one sector of the market. And now for one of the favorite benefits for commercial real estate investors of buying commercial property, the tax benefits. Investing in commercial real estate offers several tax advantages that can significantly impact your overall financial picture and that you just can't get from other investment vehicles. Through strategies like cost segregation, which you can learn more about in this video here, you can accelerate the depreciation of the asset and lower your taxable income, leading to substantial tax savings and increasing your returns overall. Let's look at some of the tax benefits you'll have as a commercial real estate investor. Depreciation. Depreciation, which is a non-cash expense that reduces the taxable income of the property, is a lowering of the value of the property on paper as it ages over time. You can also defer capital gains taxes by utilizing a 1031 exchange when you go to sell the property. That allows you to offload one property and purchase another similar property without immediate tax consequences. You can dive further into the 1031 exchange in my video here. There are also a variety of deductible expenses related to commercial real estate investment, such as property management fees, insurance premiums, repairs, and maintenance costs, which you can deduct from your taxable income. Mortgage interest is also tax deductible, so you get a tax break for borrowing money to buy property. Cost segregation allows for the acceleration of depreciation deductions by segregating different components of a property and assigning shorter depreciation schedules to certain assets, resulting in increased tax benefits. Instead of using straight-line depreciation to write off 1/39th of the depreciation of the property over 39 years, you can write off significant improvements in 5 to 7 years and lower your tax exposure even faster. Certain commercial real estate investments may also qualify for passive loss deductions, which can offset income and other passive activities, and again, reduce your overall tax liability. What do you think? Is commercial real estate investing worth it? Watch this video next to learn how commercial real estate really works.